Good evening, everyone. I can see people are coming onto this webinar fast. Thank you for being right on time. We have an interesting conversation lined up for you this evening. We'll be talking about the psychology of investing in the stock market. So we'll give a couple of minutes for people to join in, and please share it with your friends, the link to this webinar, so that as many people as possible can join in and learn a thing or two about investing in the stock market. We're already at 150 participants. I'll give a couple of seconds more, and then we can get this conversation going. As I mentioned, please share the link to this webinar with your friends in your WhatsApp groups, your Telegram groups, so that as many people as possible can join and benefit from this conversation. We have a group of very interesting panelists who will be breaking down the topic of the evening. Now we are at 156, and I think we can get started as more and more people join. So thank you so much for making time to be with us this evening as we discuss the topic, the psychology of investing in the stock market. Now, we have a great panel of experts who will be breaking down this topic for us. And first and foremost, we have Esther Waititu. Some people call her Empessa. She is the Chief Financial Services Officer at Safaricom PLC. Good evening, Esther.
Good evening.
Welcome. We also have David Wainaina, who is the Head of Trading, Data and Analytics at the Nairobi Securities Exchange, the NSE. Good evening, David.
Good evening, and thank you very much for having me. Thank you.
Glad to have you on board. And last but not least, we have Robert Ocheng, who is the CEO and co-founder of Abojani Investment. Good evening, Robert.
Good evening, everyone.
Good to have you on board. Now, if you have been following Abojani for a while, you know we are about the mindset, the tool set, and the skill set. And today's webinar is going to be about the mindset as well as giving you the tool set to make sure that you are ready to invest in the stock market. And in case you have any questions throughout this conversation, please go to the chat box below and you can type your questions there, and we will sample those as the conversation goes along and at the tail end of this webinar. So this webinar is brought to you by Abojani in collaboration with Empessa as well as NSE, the Nairobi Securities Exchange, and we're talking all about the psychology of investing in the stock market. So I'd like us to get right into it. And Esther, I will start with you. You know, Empessa has evolved quite significantly over the years, and now we're hearing about an Empessa 2.0. So I'd like you to start by telling us a little bit more about the ZD Trader and how exactly it fits into that evolution and the role it can play in helping people manage and grow their money.
Great. Thank you so much, Glenn. It's a pleasure to be here this evening, and I'm just wishing everyone in their spaces of comfort a wonderful evening. So Empessa turned 18 last year, and we've just turned 19. And one of the commitments that we've always made as a financial service is simplifying access for every single individual that we work with. Empessa started as a very simple use case around sending money home, and that's what we call Empessa 1.0. And payment still remains the key and core of everything that we do. But Empessa 2.0 is around how do we ensure not just inclusion, but ensuring that we are in a position to make sure we've simplified everything around money, because we're a money movement at the end of the day. So our commitment as part of our next chapter of growth as we become adults, it's around ensuring that financial health continues to be strong. How are we enabling individuals to grow, to access credit, and to access credit responsibly? How are we helping individuals to save and to save for a rainy day that helps them to preserve the capital that they have? And so the next step when we think about ZD Trader, it's then how we then start to grow and multiply our wealth. So we're moving beyond just simply doing transactions and enablement, but we're actually taking you through a journey of where you're able to then create wealth. So ZD Trader was a natural progression that makes something traditionally, which was very complex, to become very simple, becomes really accessible, and just simply becomes part of everyday finance. So the role that we're going to be playing as we enable the capital markets is quite powerful. It's using, in Robert's words, we're giving you a tool set and giving you a mindset, because when something is simple, you're able to try. And when you try, you get experience. And with experience, you're able to grow and multiply your wealth. So that's the next journey for us in Empessa 2.0. And that's really around our journey around making investments even simpler for every single customer that we work with.
Thank you for that. It's really about simplifying the whole investment journey. And we'll speak a little bit more about that as the conversation goes along. But I'd like to bring in David at this point. And we've seen quite a number of developments in the market recently, alongside the NSE's broader strategy to grow participation. Now, I'd like to know from you, what are some of the key priorities that you have right now, and where do you see the market heading?
Good. Thank you very, very much. So, to your point, we are on a journey as the exchange. And last year, and this is in the public domain, we came up with very, very bold strategy, because at 70 years, because the exchange this year will be 71 years, we said that we must make some very, very strategic choices for us to take this market further. Before I give you the choices that we make, let me say that we are having this webinar at a very, very good time when the market has returned in excess of 12% since the beginning of the year and growing. I must also say that we have not seen it from where we sit, because the highest we have ever gotten into was around 2008, when this index traded at about 6,100. So you can argue that we are barely half the mark. So there is a second half that will come through. But back to your question around our strategic choices, how are we going to maintain this momentum? So we made three very key strategic choices. One is that we must revitalize this market. And that is a very key pillar for us. And one of the ways for us to ensure that we revitalize this market is to ensure that, one, there is the simplicity, again, to Robert's word, in terms of the toolkit, there is simplicity of access. And that is why we're engaging with the right partners. Some of the efforts we have brought to the market is around ZD. Our traders, our participants are also working very, very hard to ensure that the ease of access is brought to the benefit of the investor. The second thing we have done is that we have broken the entry level. Previously, an investor would be required to be able to buy a minimum of 100 shares. We all know that given the pricing of these shares, that could have been a stretch. So what we have done as part of this strategic choice is that we have ensured that we bring that down to as low as 1 share. So today, if a share is trading at under 5 shillings, and we know there is quite a number, then that does not stretch the investor. You can easily come into the picture and engage with a share of your choice. The second thing we are doing around that market revitalization is that we are very, very keen that as we do all these things, then we must engage with the mindset of the investor. So financial awareness is a very key focus for us. Again, we know as an exchange, as part of that choice, we cannot be able to scratch the ground alone. So we're engaging with the right partners to ensure that we push this financial education to the right places, including the conversation we are having today with Abojani. So once we combine all those factors, we are certain that at the end of the day, we'll be able to achieve a number of things. One, we are going to grow our investment base. Currently, we have under 1 million active investors. Our view is to get to 9 million active investors by the year 2029. From the homework we have done and the partners we have brought on board, we are certain that Christmas might come early, because that 9 million, we might end up getting it earlier. The second thing we are doing is that on the supply side, again, it's very, very important that once we bring these investors into the picture, then they must have options in terms of investment. So we are working very hard to ensure there are quality listings that are coming on board. The market will appreciate that we have already had Kenya Pipeline, Safaricom, who are also present here, have come in with a bond. We know East African breweries have also listed a bond. For the first time, we have a multi-currency product in form of a REIT that came in around 2 weeks. So again, we are working on both demand and supply to ensure that we sustain the momentum of this market in line of getting to the peak and probably surpass the peak that we have seen those 20 or so years ago. Thank you.
Okay, thanks for that. I like all the developments that are being made towards revitalizing the market. That issue of just making it possible for one person to buy just one share. You don't have to buy those 100. So it's becoming more and more accessible and making sure that there are quality listings there. Now, Robert, let's talk about that. You know, with investing getting more and more accessible, talk to us about mindset of investors. How do you see the typical mindset of a first-time investor being today? And what attitudes do you think they bring when they start exploring the stock market?
Thank you, Claire. So usually we look at financial management into three pillars. So you look at the mindset, skill set, and tool set. So mindset is where it all begins, and it means that you really need to be aware of yourself, and that is a journey. And is one reason why we say that personal finance is part of self-mastery and self-awareness. So it's a lifelong journey. So when you get started, just giving you my personal experience, I remember there's a time I bought Unga Group shares, and they're at 29 Kenya shillings. So they went to 22 to 29. From 29, they went to 32. So I got excited, felt like I should have sold, didn't sell, then went back to 29. I panicked and sold, then it went all the way to 50. So these are things, we call it character development, and you really need to get into the market. Start with a little amount. Then as you go through the cycles and seasons, you'll get to learn. So that's very, very important that as you get into the market, be very open to learning, and know that as you build the stamina is when you should now be able to expose yourself to more in terms of the amount that you are investing. So the downside that you'll have now is that there's information age. And what I want to guide the listeners here is that finance is just like medicine. And you don't see doctors hawking the prescriptions on Twitter or anywhere. So you need to be careful and work with professionals. And that's the reason why we brought to you the NSE and Safaricom, people who are specialists in this type of conversations. So once you're around them, you'll see how careful they are with their words. The same way the medic is always careful. They'll ask you, did you travel outside Nairobi? Then they look at the information and they're able to guide you. So it's key, first of all, to prevent yourself from the information overload. Be very keen on the sources of information that you listen to or follow. Don't just follow anything that has gone viral, because different people play different roles in the market. For example, there are people who cannot be held accountable for anything they post. Every day they'll tell you now the market has been going up the last 10 days. When it is going down, again, they are telling you that, but they'll never tell you that this is the opportunity. So it's very, very important that when you go to the Nairobi Securities Exchange website or the CMA website, you look at the market participants. They have experts, and we've been pushing them to come out more because this is their field. So you really need to have that written down. And the journey that we are starting is like the way you got into class 1, you are patient, you got to class 8. So actually you've done a lot more in your personal life to be even a medic. So that's the kind of game that you'll get in investing. And you'll now see when people say that buy when everything is red in the street, is because they've seen it time and time again that you're investing in value. So what do I mean by investing in value? Let's say you look at a company such as Safaricom, KCB, etc. Look at it as a company that has been around for decades. Look at its revenue growth. Look at products and services that you are using. So that is what we're investing in. So that means that in the short term, the share price can fluctuate. But as long as these products and services matter, whether it is in the agriculture sector, you'll be able to invest in that growth and grow with it. So it's very, very important to know that being a beginner is okay, but is part of the game. So you'll pay the school fees with the entry mistakes, but over time, you'll build the stamina. You'll have gotten the dividends, you'll reinvest, and you'll see the growth in your portfolio. So that is the encouragement that I can give people, that doing is actually what motivates you better than any other motivational talks that you get outside here. Thank you.
Okay, thank you. I like the way you say you need to be in the game. You cannot sit back and think that you can be too careful. And there's part of that character development that comes, but you learn, you pay that school fees. And the way you said, finance is like medicine. You don't just see people hawking things around. So you need to understand, you need to engage the experts. And that's why we're here with the experts to break down these concepts and really understand how to invest in the stock market from a wise position. Now, keep your questions coming in. I can see them streaming in, and we'll sample them as the conversation goes along. But Esther, I'd like to get a feel of the experiences people have with ZD Trader. So from what you've observed in these early days, how are people behaving when they start investing through ZD Trader? Are there some common patterns that stand out to you? Unmute your mic.
Apologies. I didn't want any background interference. Okay, I was just building on what Robert had said around the skill set, and I'm going to speak around how that has shown up in a lot of what we're observing in consumers. So we're seeing a lot of curiosity. People are curious. They're like, what does it mean to buy shares? What do shares? Which share should I buy? So getting many questions around which share should I buy? How do I make purchase decisions around the shares that I'm going to be purchasing? And then we've also seen a big influx of retail investors. So we have over 400,000 customers that have opted in, which is a great number. And as David had spoken earlier, there's a very ambitious plan to get to 9 million retail customers. And I know for a long time, just as the Securities Exchange was turning 70, we only had about 200,000 retail customers. So this number having doubled in the 2 months that we have been open with ZD Trader shows you that there's a lot of hunger from a lot of retail investors to just test and see what's going on. So curiosity is one of the key things that we have observed amongst our customer base. And we've seen people testing with small amounts. And this is why simplicity is really key. When we first started, the average ticket sizes were quite small. On average, people were testing and buying shares of 70 shillings, 100 shillings. But with time, as they've been making these small purchases, we've seen that the deal sizes are starting to increase. And that's also seen in the value that we're starting to contribute when you look at the Nairobi Securities Exchange. When we first started, we accounted for about 2% of the total values being traded on the Securities Exchange. And now that's gone up to 5%, which is quite encouraging because people are getting over the curiosity and sampling a lot more. The other thing that we've also picked up here is that, there's need for a lot of education, customer education and guided investment, practices. So we found a lot of people understand the fundamentals of investing, but everyone is curious to say, how can I make better investment decisions? How can I assess whether I am risk averse, whether, I'm a risk taker? And so, for example, this evening, as we're sitting together, it's a great example of how we're educating, consumers around how they can work with money. And we know that there have been very many efforts by the Capital Markets Authority, the Nairobi Securities Exchange, and very many other partners out there. But we believe that using an intelligence is going to be a very critical thing as we move forward. We will be embedding intelligence in a lot of our platforms so that you can ask proactive questions and get insights in terms of the areas that you're looking to invest in. And I'd also encourage everyone who's interested in ZD Trader. The FAQs, the frequently asked questions are available on our website so that you can get a lot more information. Please continue to attend a lot more of these webinars so that we can continue to answer your questions and give you insights. And the other thing is partnering with partners like Abojani, where we are on the session today, so that we can share not only investment tips, but also tools that you can use to grow the business. And this is part of our commitment together with the Securities Exchange to make sure we're reaching as many audiences as possible in order for us to get that education out there.
Thank you. Thank you so much. I like the way you said sometimes you just need to also go to the website. The FAQs have so much information. If you just take the time to go through, a lot of your questions are answered, as well as webinars such as this. And it's interesting to hear that the deal sizes were as small as 100 bob. Initially, people just dipping their toes, and then they're saying, okay, I can do this. And then you continue increasing your deal size. And that's what we're saying. You've got to be in the game to benefit. So you must start, learn, and go as you continue in this stock market. But I'd like to hear from David. When the rubber hits the road, investors get in, and then prices start to move almost immediately. What's that biggest thing or biggest misunderstanding investors have about trying to interpret the movements? Because some people get scared, some people get excited. What are some of the trends you see there?
Good, thank you once again. It's a great question. So this movement of prices when an investor comes in, it's actually at the heart of the mindset. I can tell you that most of the new investors, when they're coming to the market, they have one mindset, that the price is going to go up, we are going to make money, happy days. Now, I must put this into context that is not usually always the case, as it were. So when you get in as a new investor, there are three options that are going to happen once you are in the game. One is that the price you entered into for that share might go up, it might remain flat, or it might dip. And that direction depends on the information that you have. And that is why it is crystal important before you put your money into a share, you have the right information. The misconception to your question comes in when the share dips. When I buy a share at X and it gets to X minus, from a mindset perspective, that is where investors being human, like you and I, we start to panic and we say, this dip might be permanent, so I want to exit, there is no hope, and there's a sort of a panic. And most of them may decide to sell. I'll give you an example because this is public information. When Safaricom came to the market in 2006, the share was being offered at 5 shillings. We went up to about 7, 8 or thereabout. And then the security dipped as low as 2 shillings and 20 cents. Within that ecosystem, the investor's mindset was tested significantly because from 5 to 7, decisions were made. From 7 to 2, decisions were made. I can tell you today, the security is trading at 28 shillings. And this is the crack of the mindset. What should I do when my expectations are not met? And that is investment. For example, you will buy a share that is trading at, for example, 10 shillings. It comes down to 1 shilling. And then you have a dividend of 2 shillings. Have you lost anything? The answer is no. So with this kind of information, you are able to make rational decisions going forward. So to your question, the biggest misconception is that when a security you have bought at X loses value by way of price depreciation, that dip is permanent. Usually it's not. And what we want to encourage, especially the new investors or anyone who wants to enhance their portfolio, is that in the event that happens, have the right advice, have the right information, because when you go to your advisor and they tell you that this security has dipped by X and it is an opportunity for you to buy more, actually with the right information, probably that's the right strategy. So we want to encourage everybody, just to answer your question, that this mindset that when a share loses price value, it is the end of the world and it is permanent, it is actually not factual. Let us have the right information so that misconception that dipping of a share means a permanent loss, actually you have not realized your gains. Let us have the right information and the right advice so that we can make the right decisions into the future. Thank you.
Thank you for that. And I'd like our listeners to participate a little bit. Tell us, when you think of the stock market, what are the biggest things that excite you and what are the things that give you fear? The way David is talking about, you buy it at X and then it dips and then you're like, oh my goodness, it's the end of the world. What are some of the things that excite you? What are some of the things that make you worry? But David, the way you're talking about understanding fundamentals, it's very important. And Abojani says this all the time. You need to understand fundamentals. That's why they even have a masterclass so that you can understand, okay, if I am buying this share, why why am I doing that? Because there's the dividends, as you said, there is capital appreciation. So you have to understand all the dynamics before looking at something in plain figures and not really understanding the back of it. But Robert, speak to us a little bit more about this emotional investing in real terms. What does that look like for a first-time investor? And how do you recognize it and catch yourself? You see you're buying this share and then you start acting, oh my goodness, it's going down. How do you catch yourself and realize, okay, am I investing emotionally or do I understand the fundamentals, my time horizon, and so on and so forth?
Yeah, thank you, Claire. So first of all, I would say that there are a lot of activities in the market. And like David has said, we are human beings. So sometimes we are told that we are irrational, but it is the nature of human beings to be irrational because that's part of emotions. So the first thing that you can do with self-management, in my opinion, is that you need to start with a financial plan, know where you are going, and write your goals on the left side and the amount of money that you're going to need to achieve them. And we always encourage people to spend at least 1 hour per month looking at your finances. When you do 1 hour per month in a year, that is just half a day. It's 12 hours only. So you have time for all other things, but sometimes you forget your money. So by the time you start writing, it will help you to know that when I'm getting into the market, I'm getting into the market for my goals. Then the other thing that you need to do, have a journal where you are writing down why you are buying certain shares. Because sometimes people come to us and they ask us, should I sell these shares? So when we tell them, I don't know, I want to know your goals, they say that you are being rude. Just tell me whether I should sell or not. Then I'm like, I don't know why you bought them. Maybe Nyota Yako is there. You can actually sell KCB at 30, then it goes all the way to 75. Then you'll say, I'm the reason why you are not able to buy your house. So when you write down, you'll know that, for example, let's say you're working towards building a portfolio of 10 million. So you're just getting started, getting started now, and you'll say that now you are at 100,000. Then you'll have different elements in that portfolio. So like you have your different fruits in a basket. So you'll say for shares, your journey is to grow towards 2 million in the next 10 or 20 years. So you see, when you're buying these shares, you are aligned with your goals and you'll tend to be more driven than when you have no idea. When you have no direction, you'll just see something has gone viral on Twitter, then you log in, you buy. Tomorrow, the same people will be talking negatively about the same company. You panic and you sell. So you'll just be moving because you don't have direction. So it's very, very important to come from a point of having an idea where you are headed, then knowing what the value that investing in shares is going to bring into your portfolio. So I always tell people that there are 3 kinds of investment you can make. We have debt instruments, things like money market or treasury bills and bonds. Then you have real assets like real estate. Then you have equities or business ownership. So as we can see now, we are moving into ownership economy. So ownership economy means that the idea of jobs, no one really know how it will turn out, but we've clearly seen some companies becoming more efficient. They're using machines, AI, and they're generating more value and their share prices are going up. So when you have strong fundamentals that are guiding you and you keep learning and reading books, you'll have some sort of stamina. So that stamina is what can prevent you from making emotional decisions. Because by default, even there's a psychologist that say that there are two ways of thinking. There's system 1, where you just react. Then system 2 is when you try to rationalize, like you try to see, why did I make this decision? So it's important to accept that you are human and to guide ourselves or guard ourselves against the downside, have some rules, and sometimes have even accountability partners. Like personally, I have an accountability partner because I know since I'm in the market, I can get carried away. I can attend an event and things look so great. Like today, we attended one bank releasing their results, and the results were so great. So I would go and ask my accountability partner, this is what I've seen. What do you think? You'll be surprised that sometimes there's an angle that you've missed, and now they are guiding you. So it's very important. Then the journal will tell you that when you bought this piece of land in Kitengele or this stock, this is why you bought it. So when you want to change your mind, you'll actually see whether the facts still remain or the facts have changed. But by default, we are emotional. So it's very key to see that having a framework to prevent the downside is to have a logical way of making investment decisions, because investing generally is logical, but the downside is that we are humans who tend to be emotional.
Okay, thanks. Yes, we are emotional. I can see a number of comments coming through on your experiences. Keep them coming. We'll sample them as we go along. And I like the way you said you just need to catch yourself. Get yourself an accountability partner. If you know you tend to fly off the handle or get too carried away, just have someone who can call you back into check. And that money journal, it's also important. How long do you spend just analyzing your financial situation every month? We do so many things, but do we spend time understanding our financial situation? It's something to really think about. And Abojani even has a money journal, so you can consider that. Now, Esther, let's talk a little bit about this accessibility. It's a great thing, but if it's not used well, then it can end up going the other way. So when investing becomes this accessible, there's that risk of people now focusing on doing more rather than understanding more. So how do we correct that behavior? Because you think, okay, I'll go here, I'll go there, a little bit of this, a little bit of that, but are you really understanding how you're investing? How do we make sure that we're doing it correctly?
Great. That's a fantastic question because, as I said, when we started, we're seeing a lot of people experimenting and even now going up to bigger values. And the issue that you pointed out around doing more than understanding is one that's at the core of what we do. And we always encourage all of our customers to seek advice in areas where, they are not clear. And when you think about the tools that are available, where they can ask questions, which would be really, really key. Now, accessibility should not come at the expense of lack of understanding. And it's quite interesting because we learn from others' experiences. And to use a typical example that's happened here in Kenya, and maybe the audiences may be different, but there's a time when a few people had made quite a bit of money from quail farming, and everyone got into quail, and that killed the whole demand system, because when there were too many people producing and there were not as many takers, the whole system just didn't work. And so for us, when we think about accessibility, we also have designed our experience in such a way that we guide through behavior. And how we're guiding through behavioral shifts is very simple. We're using insights and educational cues to encourage customers to pause and reflect. I really like what Robert has said, where you have a journal where you can actually take note of what is going on. And the good thing is that we're in the digital age. So in the digital age, you're also able to reflect on that statement around your trades and see, what have I been able to buy? What are the movements? They're very clear symbols, what has moved up, what has moved down. So that should be a point at which we then pause and reflect and say, do we want to get more? Do we understand what is fundamentally shifting? And if you're comfortable with the risk and you feel like you're getting a better price, even as the price moves downwards, then you act. So the goal is to make investments a long-term learning journey, and part of how people then work with money a lot more effectively. We also really emphasize the simplification, not making the process too complex, so that we can then give people the breadth and the room to seek clarity. And clarity comes through understanding why you're purchasing that particular stock. What is shifting in our environment that I need to take advantage of? So it's not just doing because others are doing, but it's ensuring that we're giving you the right cues that enable you to make better decisions, enable you also to become familiar with the process over a period of time. And that then helps us to build healthier investing habits. So my encouragement here is that when you think about behavior, experiment, but with everything you do at the end of each day, take a step back and say, what have I learned? What opportunities exist out there? And then start to take advantage of that. That will enable us to ensure that we're not just doing, but we're spending time in reflecting and understanding why things are shifting and where the opportunities actually lie. And so I'll encourage everyone to leverage the tools that they have around them. There's a lot of investment material that exists on very specific, I referenced our website, but then there are also great investment advisors who can walk the journey with you. We also need to use our own intuition. And our own intuition comes from making sure that you are leveraging the tools that you have in your toolkit that can give you very clear cues in terms of what needs to shift. So that's how I believe we can correct the behavior of just acting, as opposed to taking time to reflect and building good investment habits.
Okay, thank you. So reflect, and you're saying something that, if you've been following Abojani webinars, we also had a stock webinar last month. What is your why? That was the same message that was being put out there. What is your why? You have to understand that, and personal finance is very personal. So don't go with what everybody is saying. Understand your why, and when you have that clarity, it makes investing that much easier. Now, I'd like to go back to David, but I can see a comment here. Let me just sample it here. Ernest is saying, can I get an accountability partner here? Yes, you can. This is a community of investors, Abojani, so I'm sure you can get somebody on your journey with you there. But I'd like us to talk, David, about we are investing in understanding so that we are not just investing anyhow, but sometimes the market moves in a way that doesn't match the news or our expectations. Now, tell us, what are some of the wrong conclusions that investors usually jump to when those situations arise?
Good. So markets will not match our expectations all the time, because if that was to happen, I think we will all have met our financial goals. And that's why sometimes they are buyers and sometimes they are sellers on account of what we call material information. A company has announced their financials today. There are people who will interpret that differently. Some will be on the buying side, some will be on the selling side. But sometimes, as the case may be, you will have a very good announcement from a company, for example, a bonus issue or a healthy dividend. We all know that is good information. But where the price was before the announcement and where the price gets after the announcement, they don't match. There is an inverse relationship between the announcement and the price direction. That is the market for you. And this is where our mindset comes in. Because if, for example, there is that very good announcement and you take a decision to buy and the market does not react to your expectation, one of the things that as humans you will be, sometimes forced to believe is that I have made a very wrong decision. But strictly speaking, markets are either efficient, semi-efficient, or not efficient. A lot of research has been done across our market by very serious scholars, both local and international, and it has been qualified that our markets lies between super efficient and efficient. So we have a very efficient market. In an efficient market, your emotions and instincts will not always transition in the market. And this is where it is very, very important once a market information is relayed, don't be reactive. Don't react on that announcement day. Don't react on the midterm. At least give it time for it to sink and for the market to be able to get its correct position. Because if the announcement is right by an issuer, it does not matter how long it will take. The market will correct itself to the correct price point. And that's why, depending on who you are engaging, of course, initially, as Robert has said, once you are working from an announcement, we will be super emotional and saying it's a good or bad announcement. So if you decide to make your investment decision based on that emotional layer information, it can tilt either way. So what we are saying here is that engage with yourselves, and also depending on the level of the information you have, in addition to your advisors, please ensure that you do some form of analysis using the insights from the right sources to ensure that you are making the right decisions. Because failure to do that, you'll find a very good announcement, the market turns against you, and then you say, I have made a very bad decision. As a matter of fact, if today there is a very good announcement and the market does not react today, downstream, because there is a window within which this information comes to play to act on this information, then it is going to correct itself to the right position. So please be patient. As long as you are investing, you are not sort of doing other things with the share. As long as it is investment, you have the right information, you are crystal clear that you are either buying or selling based on the information you have, there is no wrong decision. The wrong decision that, make us think that we have made a wrong decision is whereby you have made a decision blind. It is an emotional decision. So we want to encourage our new investors that let's not be guided by emotions. Let's be guided by the right information that is well analyzed, depending on the information you have, depending on who you are engaging, so that you can make the right decisions. Back to you.
Thanks for that. And Robert, I want you to comment on that same issue as well. David is saying that sneaky thing called doubt can come, and then you start doing the wrong thing. So, as he said, it's not utopia. So sometimes things go in an unexpected way. So what advice would you give to investors who start doubting their decisions, and how do they move from that and avoid making the wrong decision after that?
Yeah, thank you, Claire. So in the market, the paradox in the market is that there are different players, and I usually use the perspective story of a pineapple. If you have a pineapple there, there's someone who is selling it and there's someone who is buying it. So the person who is selling it will always try to get the highest price, and the person who is buying it will always tend to want the lowest price. So you should know that if you are one of those two, you should always look for your best interest. So the way the financial markets are designed, you'll see when the share prices are going up, there's green, there's red. There are people who trade, they're called day traders or short term, and they like activity. But the activity might not work for entrepreneurs or professionals. In the morning, 8 to 5, you are working maybe at KCB, your company, etc. So for you, probably is the long term that would work, and studies have shown that that is what works for majority of the people. So if you fall for the short term people, you'll actually be falling for their agenda. So it's very, very important to know who we are and know whether we have low risk appetite, medium risk appetite, or high risk appetite. And the risk appetite is not an opinion. Yeah, it's easy for us to say we are this or that. You should just know that if you bought companies of shares of a certain company, let's say at 55, and it falls to 50, the emotional reaction is who you are. If you are someone who is high risk, that would be okay for you. But a low risk person might not sleep. Even eating food might be a problem. And these are things that happen to people, that they've invested, all of a sudden we call you and we wonder, is that my friend Claire? Kumbe, it is shares and you're not telling us. So it's very, very important to learn yourself. And that's why when you get into tools like ZD, put your 10,000 there and learn. Consider it as part of your school fees. There you paid school fees somewhere else. Then once you learn who you really are, then you go heavy in that. And the other thing is that information breeds confidence. I've been challenging my fellow Kenyans. We are too much into politics and social, like a lot of information that is being shared there. Actually, for us, when we wake up in the morning as Abojani, we just pray that fellow Kenyans, you can give us 2% of your time online. And I hope one day it will reach 5%, because we know the competition is social and political. So we need to get into more financial conversation, because once we learn the financial conversations, things like the value of the companies, some people might not know that our banks are making quite a lot of money outside Kenya, 25% and above in terms of regional contribution. And research by IMF have shown that East African bloc, you are the fastest growing region globally. So 20 years from now, you'll be telling your grandchildren, do you know when I was 40 or 35 or 30, actually we are the fastest growing region globally. And that's why you are seeing a lot of interest in Kenya, from transaction point of view, because these economies, Kenya, Uganda, Rwanda, and there are companies that have been embedded into that. Then there's the youthful element. You see, the youthful element means that there are some companies that are advantaged. If the youths are techie or digital savvy, it means that companies that are going heavy into digital transformation, they're likely to do well. So once you have such information backing you, then it boosts your confidence. But when you have no information, you'll go with whatever is being said. And the information age, the agendas, the algorithms will always try to find something trending, because social media cannot do without a trending subject in a day. Yet your goals are long-term. Your goals are 5 years. Like personally, my goal was that I would leave corporate by the age 33. So I didn't make it. I left at 35. So you see, that goal is bigger than what is happening today. It's bigger than what is trending, you know. It's bigger than the hot tips. Once you achieve it, that is it. And I usually say, achieving these goals is like an Olympic gold medal in your personal life. You don't have to be a marathoner. Have a goal. I want to buy this, that. You want to buy your car, your house. Believe you me, that is what people say to be happiness. When you say this is a goal and you achieve it, you'll be very happy. So that will guide you to know that you don't need to react on what is happening on a day-to-day basis. You need to stick to your plan, and then you keep going and you keep going strong. So it's just to balance the human element and the aspirations that you have.
Okay, thanks. So just know your long-term goals and don't look at algorithms and hot tips. Just focus on your own goals. And it's like you were speaking to me, Robert, because I had a moment one time when the market was going left and I was losing sleep. I was really losing sleep. So just catching yourself and not being an emotional investor is very important. But Esther, I'd like you to tell us, what are some of the patterns you see when people experience either their first loss or their first gain?
Great. It's a very good question. And let me start with the first gain. It's always good to start on the positive side. So what we see is confidence starts to build when our customers, experience a gain in one of the shares that they have bought. So it gives them a lot of confidence. It gives them, the ability to want to do more. We see them purchasing a lot more, in getting involved and even experimenting with different stocks. And what ZD does in a situation like this is that it encourages you to actually, it gives you the encouragement to say it is possible. You're then able to easily absorb information, because when you've done well, then you're eager. You want to see what more you can do. So it gives a lot of confidence in that space. With trading, we'll also lose some money. So when you do lose money, what we have seen is that we've seen investors also can withdraw because the loss may be too hard to bear. Anything that causes you to lose the thing that you believe was most precious causes you to withdraw. Again, what we then encourage you with ZD is not to necessarily withdraw, but to see the other opportunities that exist where you could potentially start to make money. So those are the two reactions that we see. But in the end, what is it that we're looking to achieve, especially by making sure that investing is very simple? We're there to make sure that we're giving you the confidence. And we're telling you upfront that, yes, you can lose money. We're telling you upfront you can gain money. We're giving you then the tools that enable you to be able to make the right decisions as and when you're investing. So this is now starting to build this whole ecosystem around sharing of information, creating a community where you can trade and see what is going on, allowing you to have the moments, like I mentioned earlier, to pause and reflect. That is really what happens. And that's where we want to get you to, because both are true. You will lose at some point and you'll definitely gain in some point. It mirrors your experiences in life. One day you're going to be happy, another day you're going to be unhappy. But none of these situations are permanent. And our role as partners in your investment journey is to give you the confidence and to help you to enjoy the moments when you have made money, but to help you to learn from the moments where you have lost money, so that we can then encourage you to have a consistent way of saving and investing over a period of time. Because like Robert and David have said, it's not a sprint, it is a marathon. And everything will even out with time. And so ours is to give people the confidence, the courage to be able to invest, and to make sure that we're looking at it not from an occasion, but to look at it over a period of time.
Okay, thanks. So things even out over the long run. So don't get too frustrated. You win some, you lose some. That's c'est la vie. That's life. Yeah. So just know how to deal with those different situations. Now, David, you spoke to this a little bit, but I'd like you to speak a little bit more about that misunderstanding that frustrates investors most when a trade doesn't go through as expected.
Sure. So let me first say that the way trading is done at the exchange, it is extremely democratic in the sense that you are guided by first, what is your price point? And number two, what time did you come in? The market trades on something we call first price, two timestamp priority. What this means is that if, for example, between myself and Esther, we are buying NSC shares, and my order came in first at 16 shillings, then it means that her order is going to queue because we are queued by the time we came in and the price. However, if Robert's order was at 17 shillings, it means that his order is superior to us, so it will take preference because it's of a better price at 17 than our price, which is at 16. Equally, on the contra side, it is the reverse. The cheaper the priority on the order. So on the sell side, we start with the way the orders are cheap. On the buy side, the way the orders are expensive. And these two positions are going to match. And when there is an agreement between the buying price and the selling price, then that transaction will match. This is where the frustration comes in. If, for example, at 17, Robert and I had placed an order and he gets his order first because the supply was not enough at 17 and I lose out, then at the end of the day, I'm going to ask my broker, look, I had given you an order. I can see there were transactions at 17. So I'll be extremely frustrated, especially if in the subsequent day, that share turns and it goes up. I will feel like I have lost an opportunity. So what we need to do is that when we are going to our advisors or when we are putting an order, it is very, very important that we are very clear, one, on the price point that we want to acquire our shares at or sell. And number two, the time period within which we want to execute our transactions. For example, if I have an agency and I need the money as soon as yesterday, then when I go to the market, I need not to restrict myself on the price. I need to go to the market and say, you sell my scripts because I know the market cannot go beyond 10%. Whatever price I get from the market, put it as a market order. Chances are very high that that order, if you're selling, will get priority and you'll get your money immediately. The frustration, therefore, comes in when an investor loses that opportunity. From the information perspective, they can see the price they wanted to execute their securities have already been executed. So they will come and start thinking that probably, one, either the advisors were not as fast. And that is why the toolkit that you're using to come to market is very important, because if you did it yourselves, for example, you're able to access the market like the way there are apps or even the ZDs as tools to get you into the market, then you will not have someone to blame because you clearly know that I was queuing in the market, but because of the market dynamics, my order was not able to be executed. So that frustrates, especially where it is being executed in a manner that an investor does not understand. And that's why it's very, very important, even as we engage our new and existing investors, we qualify to them as part of these awareness programs, how transactions happen at the exchange. So that frustration can be cured by way of ensuring that investors understand how trade, because they will be able to give the right orders. If they are, for example, in quotes, they are desperate, will not put a price, and that order will execute. The final frustration is, and we have had this very, very clear from investors, is where an investor will sell their shares. And then because our markets trade within the cycle of 3 days, then they will have to wait a bit for their money. Kenyans and local investors, because we are super aligned to the retail strategy, once when they sell, give me my money, cash pap. And when I buy, give me my securities. So the tool points that we are having are aligned to that expectation of investors, that if I buy, I receive my money immediately, if not real time. And if I sell, I receive my shares. And some of the initiatives we have in the market, including some of the apps, including ZD, they are aligned to that strategy, so that we don't frustrate the investors from a buying or a selling perspective. Clara.
Thank you for that. And thanks for breaking down those market dynamics so that people can understand really what goes on and they don't get too frustrated. And as you said, people want cash pap. I've sold it. Where's my money? So thanks for breaking that down. Now, Robert, speak to us about some of these impulsive decisions that people take. We're talking about the psychology of the stock market. What are some of those traps that feel right when you're doing it at the moment, but then later on, it's harmful to your investment journey?
Yes, so I would say generally, the way people react to financial market news is that for most people, they usually feel an urge to do something. So whether it is a new bond that is upcoming, whether it is an IPO, whether it's a company that has issued or declared some dividends. So that is why we say we should stick to a financial plan. So a financial plan, and I usually encourage people to have what we call an opportunity fund. So opportunity fund means that you appreciate that you are not going to have money all the times. So because of that, you have something like a money market fund. So you'll have your 100,000 there, 50,000, 10,000. Then when you get these good opportunities, like the share price of the companies that you wanted to buy have gone down, which is happening currently, you go to opportunity fund, you withdraw and you buy more of them. So that kind of discipline will help you, because most people really just buy without any plan, and you'll find that they tend to buy at the highest price. And when the share prices are low and they wish they had money, they have no money. So it's important to start from a money management point of view. And like I said, look at your investing as a basket with different fruits. Yeah, you can have things like money market funds, things like bonds and shares. Then do the allocation. Then you'll just know that the year 2026, for example, like yesterday, I sat with a client and they saw that this year they're going to get passive income of 2 million Kenya shillings, and they're going to need 1.2 million for the expenses. So it means 800K is available for investments. So if you are salaried, probably 10,000 Kenya shillings per month is available for investment. Then you plan throughout the year. So that way, you'll not fall into the impulses of when an IPO is coming. Like, we got very many questions. We're even overwhelmed. And the people are asking us the questions on the IPO. They are not asking us whether we should say no or yes. They wanted validation. Like, they wanted to buy and you should say yes. So that was quite disturbing. So you see, those are the kind of impulses that would come up. Now, probably the company that recently did an IPO, the share price is still close to the IPO price. The same people now, they're not interested. So that's not the human psychology. Because like when something is on sale, they say, is it 99 Kenya shillings? So sales and marketing guru, they know whatever study they've done about us humans. So when everyone is talking about something, people are going to events, they're talking about this or that share, you are likely to want to buy it. But when it is actually available at a good price, and I can give investors here a good example. Forget about 2021, because 2021 was connected to COVID. So COVID, everything went down. So 2021, you had those abnormal growth in terms of GDP. But if you look at 2022, 2023, 2024, and 2025, actually 2023 is the year that the Kenyan economy grew the fastest. So the GDP grew by about 5.9%. But unfortunately, that is the time that shares of most companies went down the most. So it was like a paradox. So people panicked. Then 2024, like David has shared, and 2025, the market has been doing well, even 2026 year to date. So you'll find that when it is actually a good time to buy, psychologically, there won't be vibes around. Yeah, because the social media generation is all about vibe, because I hear people saying that so they seem not to be vibish. So it means they're not fun. So people want to take that into investments, and I call it the fun generation. So fun generation, they want everything to be fun. Yeah. But finance, Claire, is as boring as it gets. It's just putting that 5K there, you buy, next month again you buy. At the end of the day, you have X number of shares and you achieve your goals. So I think we really need to know that the impulses, they are part of being a human being, but to control them, have a plan and know where you are going. So if you have a plan, it really boosts your confidence in terms of, if you told yourself that you are going to do something, and you do it, it boosts your confidence. Because these days I've had, there's no one who wants to do anything conventional. People don't want to come to work at 8. Everyone doesn't want to do the conventional things. You see? So yet finance is on the conventional side. Yeah, it is that time that is painful, that you'll be doubting yourself, Claire, when you buy that share price at 15 and no one is talking about it. But it is cool to buy it at 30 when everyone is talking about it. Then that's again the time it might tank to 25. So we really need to learn how markets work, that they're long-term, that you're investing in opportunities that are connected to the real economy, like consumption and stuff like that. Like, for example, in the banking sector, people have had strong opinions about the banking sector, but it has been here for over 300, 400 years. You see, yeah, there's never really been a replacement in terms of what we call financial intermediation. So when you connect it that way, you know that you are going for the long term. And if you want to try out the new ideas, we call it wildcards. So wildcard is more of a low probability, high impact event. So such, you can say, let me set aside 5% of my portfolio for doing such things. But 95 or 80%, I'm going to do the core elements. We call them anchor stocks. So these are companies that have been tried and tested. They are stable, they have superior management, good governance, and the products and services, they are used by quite a number of people. Yeah, so the framework of mindset is really deciding to be deliberate. Then you decide how you're going to set up your portfolio. And the cyclical nature of markets, unfortunately, you cannot learn it theoretically. In a bull market, everyone will be a genius, will be very overconfident. In a bear market, you'll start doubting if you are as smart as you are at your Alliance or Starehe. So once you've gone through the cycles, you'll realize that they repeat. So David is in the market, they'll tell you there's a time the index was at 6,000, now it's still quite low by day. Yeah, so there's like a bell that is ringing behind the scenes telling you that you might consider looking at some of the opportunities. Yeah.
Okay, that's quite interesting. As you said, finance is boring or it's mundane. So don't look at it from the vibes perspective. And you also put something out there that's quite interesting. A lot of people are me too. I'd say me too. There's a bond there. Me too. I got a bond. Me too. I have this and that. But just be focused on your own personal goals and be consistent so that you can get to where you're going. And Esther, I'd like us to talk a little bit about that, because we get into the market, but beyond that, how do we build consistency? So I started out, how do I make sure that I'm disciplined? I didn't just say I'm part of this new wave. I've bought this new stock. I'm on this new app. How do I make sure that I'm consistently building my investments?
Great. It's an excellent question. And I want to build on the point that Robert has made around consistency. Yes, anything to do with numbers and money does seem very mundane and maybe not exciting as it should be. But things which need to be done consistently may not always be very exciting. So for us, we are looking at ways in which we can make this simple. With ZD Trader, we're making individuals become a lot more intentional about what they're going to invest in. So it feels less of an event, but more around a rhythm, because it's in your daily wallet, right? And you can set certain nudges and, just make it very simple. But the goal is really, and what we should be looking out for, is to make sure that we are giving our customers the ability to manage their money in a very simple and convenient way. And you can put in different nudges to do so. About 2 years ago, we introduced what you call Empessa Ratiba, which is basically a standing order. Because the things that you need to do consistently sometimes need a rhythm to doing them. If you're having to go in and do it each time, it can become a bit taxing, and this is where we fall off the rails. And so there are 3 things we should just focus on in terms of making sure that individuals are building consistency. When you're looking to build a habit, first of all, it needs to be really simple, right? By setting something up once and giving it a time frame for which you're then able to collect. And with a standing order, for example, it'll give you the ability for you to just plan once, but to have the action continue to recur. If you look at our money market fund as another example, we're putting a very simple tool that says, as you spend, let a small percentage go into your savings. And what's very interesting is that we've seen people build their savings over time by simply making a payment, and then even as small as 10 shillings, 100 shillings, or 10% of the amount that you're spending going into a savings or a money market account. And remember, the money market account, the money is compounding. So if you put money in today, you'll earn your interest the same day, but tomorrow you'll be paid interest based on the amount that you invested, plus the interest that you had received. So consistency needs to be made really simple, such that it's almost mechanical in terms of how you do it, with a process underlying it. The second thing is that it must be visible. If you're not seeing how your money is growing, and that's why you'll see in a lot of the tools that were provided on our ZD platform, you visually have graphs. Graphs are great. Graphs show you the movement. And so when you're seeing visible progress in terms of, investments growing, savings growing, it gives you the encouragement to continue doing a lot more of what you're looking to do. The third thing is it builds that discipline. That discipline is enforced when you're constantly doing the same thing over and over again, such that when you don't do it, you'll get a little nudge. Even your mind will say, there's something I'm supposed to be doing. What is it that I'm supposed to be doing? And it will take you back to do the thing that you had planned to do. So that's what we're looking to do, to make sure things are simple so that they're repeatable, to make sure that they're visible so that you have the urge and the desire to keep on growing and seeing how your money is growing. And through that, we then now start to create the disciplines that then create consistency. And that helps you as an investor to stay engaged, to stay informed, and that way you'll then deliver long-term value for your wealth portfolio.
Thanks for that. And as you said, those tool sets like Ratiba, just automating things makes life that much easier. So you don't have to keep on thinking, oh, I'm supposed to do this. It just makes life easier. Thanks for that. Now we are almost getting to the Q&A section. But David, we talked about some of the frustrations that investors have when they're in the market. But what have you seen is a lesson they've learned while interacting with the market more, that they see that, okay, this is how things work. And they had a completely wrong idea of what was going on in the market. Those misconceptions are now turned into a point of knowledge.
Good. Let me on the fly give a very significant misconception investors have been having around the exchange. One is that the NSE is an elitist sphere, and we have carried this baggage for 70 years, and I can promise our investors that this is something that we are deliberate and we are going to dismantle it in the very short term. Some of the efforts that we are having to ensure that this is done is what we have already spoken about around. One, the costs of entry from 100 to 1 share. You can see now with under 5 shillings, you start your journey. And as my colleagues have said there, that consistency of having small amounts will develop into a very big cake being baked here. And when you compound it, you're going to have a significant portfolio. Two, we are also looking inside and saying that previously, if you look at statistics, over 50% of our market has been driven by foreign investors. And I'm not saying foreign investment is bad, but what is this that our foreign investors can see that us seated here as local investors cannot see? So from the awareness that we are putting forward, we again want to change that narrative. And I am sure most of us will be able to join us on Friday as we announce our results. You will see that that deliberate effort is yielding.
I think you're breaking up, David. Okay, as we wait for him to come back. Okay, he's back.
Yeah, the conception that local investors, I mean, the conception that, it is an elitist investment, that is a narrative that we are changing through these efforts that we are having, including getting into tools that can spread across the country. In the fullness of time, some of these tools that we have brought forward, including the apps that our members have, including the likes of Zidi, I am certain that we will be able to reach to every corner of this country because, again, the exchange had been seen to be an exchange that operates within the city. We must spread that within our country, and we are deliberate, and that will be achieved. Thank you.
Thank you for that. So David and the good team at the NSC is here to tell you that it's not an elitist platform. As you heard, you can buy as little as one share. So let's get that out of our mind and participate actively in the stock market. Now, Robert, if you could point to one behavior when it comes to investing that consistently builds wealth over time, what would that be?
So thank you, Claire. So what I would say in terms of ownership, when you pick certain companies, try to look at the size over time. Because I've seen retail investors making mistake. They want to own 100 shares of this company. Tomorrow they want another, and so they want to have like 20. But look at a few good companies and start even with 10 shares. Like David has said, these days you can buy even one share. So one share is good for a start as you get to learn, but as you get more information and you find that that company is valuable and is here to stay, work towards having 100 shares, 1,000 shares, 10,000. So those people that you see on business dailies that they own 1% ETC of certain companies, most of them didn't buy them at a go. So they had just a certain number of shares that they are buying. So that will also increase the dividends that you are getting, because sometimes you find investors complaining that when they are paid dividends, the ETF fee, the EFT fees are higher than the number of shares. But the investor is forgetting that no one prevented them from buying 1,000 shares, 10,000. So let's have that goal, because when you are young, you don't see it. But believe you me, if you are like our age ETC going upwards, it will be fun to receive dividends worth 200,000. But can only get dividends worth 200,000 if you have significant number of shares. So don't see yourself as 26. See yourself as someone who's going to be 40, 50. And probably that passive income is all you need. Because if you get dividends worth 200,000 and maybe your monthly expenses are 50,000, it's like you've been paid for 4 months, you see. And next year again, you'll be paid for another 4 months. And most of the time, some of these companies, the dividends go up, maybe by 2 Kenya shillings, 3. So next year, probably you are going likely to receive more. So hold a position in terms of ownership. I know it's great to own a car in Nairobi. Everyone is competing to buy the biggest car. But let's also compete in terms of owning a certain number of Safaricom shares, KCB equity, based on your analysis, so that you can really reap the rewards of having a sizable amount in your portfolio. Because remember, the ownership is feeding into your goals, dreams, and aspirations. And all of us here will talk nicely about dreams that are worth 50,000, 100,000. So let our investments match our goals. Otherwise, the goals will just be emotional. So I always encourage people, like some parents talk, they want their kids to go to, let's say, USIU, Strathmore. But have you had the courage to look at school fees, you'll find that amount to achieve it, you need to do the consistency that Esther was talking about. 10,000 shares, tomorrow 12,000, 20,000. So I've seen that change the lives of quite a number of people. And since shares have done very well, like from 2022, I've had someone in my community, they bought shares worth 4 million, grew to 17 million, they drew 10 million, and they've bought a house. So these are stories that can happen to many people in 5 years, 10 years, 20s. But remember, what will matter is how many shares you hold. As long as the company is fundamentally sound and it is in a growing industry, it is growing, try to have that target from your ZD app. And I'm challenging everyone who is here, please, let's try so that next year, when we come back, everyone will be owning at least 1,000 shares of the company that they have. A year after that, we'll upgrade it to 2,000. So that we're also growing. So that's the whole idea of Abojani community. We are a community of growth. So there's a time that you'll find that if we are talking 10 shares, you'll be in the wrong place. But since now we are starting, we can challenge ourselves and give ourselves targets that if NSC's target is to have 9 million investors by 2029, let's say that for us, our target is to ensure that by 2029, for the company that you like the most, we call it an anchor stock. Can you have even 5,000 shares of 10,000 shares so that we're also growing in the market? Because remember, the new people who are coming from your family, colleagues, they'll be relying on you. So a whole lot of people are looking up to you, but I don't think if they'll be inspired if we've been in the market for 4 years and we just have 10 shares. Thank you.
Yeah, thanks for that. So let your investments match your goals. Start now and then build. You can't get to where you want to be today, but you need to start and you'll get there. Now, I'm just about to get to those questions, but Esther, just give us one tip for all those who are listening right now. If they're starting out on their investment journey in the stock market today, what is that one thing they should do differently that will significantly improve their experience?
Okay. So I think if there's one thing that I would advise anyone looking to invest is I'll encourage you to have, and I know Robert calls it the mindset, but I'd really encourage you to have that willingness to learn, that willingness to experiment. Because money is made in difficult times, money is made in good times. And it's sometimes very easy to focus on the returns or having a bad day. But when you're starting to invest, be clear around what your plan is. Put your money where you believe it's going to give you the best return and where you understand the stocks a lot better. And just do it whatever your time frame is, whether you're going to do it weekly, whether you're going to do it monthly, whether you're going to do it quarterly, but do it consistently. Sometimes boring, mundane is the thing that's going to get you there. But in the long term, because remember, a game of building wealth, wealth is never built in one day. Wealth is never built in one day. Wealth, similar to your health, is built over doing consistent actions over a period of time. My advice then would be, start small, stay curious, give yourself time to learn the market and how the market behaves. Approach investing with a long-term mindset and not a quick win mindset so that you can actually achieve your goals in the long term. And enjoy the journey more than anything. Don't feel constrained. Enjoy the journey. Thank you.
Thank you. Enjoy the journey. Be curious. Start small and you'll get there. Now, I'd like us to go to some of the comments and questions. There's one here from JMO, and I think I'll address that to David. Hello, I'm new and I need to know step by step how to invest in shares or someone who can assist me kindly. So, David, take that one. Let me take two others, then we can go from there. Judy Chege says, what should we expect in the financial markets in the coming days with the ongoing war in Iran, coming campaign season, and so on and so forth? Robert, you'll take that. And then there is here, Philip says, you have ZD money market. Can you advise me how I can reap from that so that I can graduate to shares later. So Esther will take that. David, start with this newbie, step by step. How do you start investing? Robert, tell us with what's going on in the world, how that affects the stock market. And then Esther, talk about ZD and how he can start taking advantage of that. Then I'll take the next round of questions.
Good. The first step is for you to have an account where you can hold your shares. And this, you have two avenues. You either go to a licensed investment advisor, and all these are available in the public domain in our website and in the CMA website. You will get them. Or two, you can use the ZD avenue through your Empessa app, download the ZD Trader app, and you get that account and you start your investment journey. So it's as simple as 1-2 steps, and you have started your investment journey. The most important thing is that whichever route you use, the question will be, where then do I start? And in ZD, you will see the market has been displayed in there, so you can choose the security that you want to invest in. If you don't have the advice, you can get in touch with your investment advisor and they will be able to guide you. When you go directly to an investment advisor, again, they should be able to give you the right information, and you're able, once you have an account with themselves, then you choose the security that you want to buy depending on the amount of money you have. So it's that simple, like 1-2 steps, and you start your journey. Thank you.
Thank you. As simple as 1-2 step. Robert, you can answer the question around the current opportunities. I'm just going to batch all the questions that are similar. There's also someone who's talking about current opportunities with the ongoing war and different issues there. So just speak about the world happenings and what opportunities and risks are in the market. And then Esther, you'll also break down ZD, because I've seen a lot of questions around ZD. Someone is also asking, can you just unpack the omnibus concept of ZD? So you'll take that all together with the questions around ZD. Robert?
Yeah, so Claire, definitely I'm biased because I'm in financial markets, but for me, usually I follow data. So my background is in tech, and within tech, I was in data. So there's something that happened in Kenya that you all need to be aware of. So the period between April and June 2020, that's at the peak of COVID. That's the time that the money market funds, unit trust, collective investment schemes industry grew the fastest since they established in the year 2002. So that's 18 years later. So it grew by 15%. So when I saw it, I'd read some book by Steve Schwarzman. He said that the time to get into an opportunity is when it is picking up. And I started looking for a way now to move from banking and come to the investment side. And truly that space has really grown. So that's the money market fund, which in my opinion feeds into investing into shares, because money market fund will buy you the luxury of having even money to invest. Then it also will buy you the peace of mind. So if you have your money market fund, it can cater for your day-to-day expenses. You can think long-term. So it's very, very important to look at things that way. So after that, now you've seen more people coming to the stock market and the numbers are going up. So from a long-term point of view, once there's access, there'll be more information, the quality will improve. So other markets grew in a similar way. So what we need to look at is the opportunities and how to get into them. And we've already seen other investors coming into the Kenyan market. And I know sometimes people argue, this bank is undervalued, overvalued, but there are people who are willing to pay 1.3 times book value of a bank, which is also something that our banks did in DRC at the peak of COVID. So that can already show you that the opportunities, they're usually timeless. But the volatility of markets by their nature, they're volatile. The Kenya shillings might fluctuate. It happened in 2011, 2015, and again the period between 2023 and 2024 there. So if you look at things from a long-term point of view, you should not be worried about the short-term headwinds. That is probably the time that should be beefing up your opportunity fund, and then you pick up some of the opportunities that are there. So I can give you a good example. You might find that a certain company is giving a dividend of 5 Kenya shillings today. Then 5 years from now, they'll be giving 20. So that has happened with a company like Stanbic. So it's public information. Go and check the dividends that they're giving in 2019. The dividend that they're giving per share has gone up 3 times. See, when I was working at Equity, the dividend that they were paying was less than 2 Kenya shillings. Now they've paid 5 Kenya shillings and 75 cents. But since then, a lot of things have happened. The Kenya shillings fluctuated. There was COVID, right? After that, there was Russia, Ukraine. Now you have this situation. So if you look at things from a long-time point of view, you should not be worried about that. So there's a book by Peter Lynch, which really empowers the retail investor. It's called One Up on Wall Street. And they give, there's Maya mythology, where they say that there's a time people thought that the world would end through floods. So they prepared an ark, then there was fire. You know, there's a time they thought that it would be fire, they prepared, it was flood. So the art of being prepared is just an illusion. The penultimate preparedness is an illusion. So just look at long term. And then when the volatility is like now, I would say that that's actually an opportunity to get in. And you can say, for example, look at the history of Kenya or the world. 1992, what happened? That time there was a bubble in Japan in terms of real estate assets, you know, stuff like that. There's the Asian economic crash, you know, there's the .com crash, there's the 2008 economic crash. But here we are using Microsoft tools and stuff like that. So from a long-term point of view, don't be swayed by the short-term volatility. So that would be my encouragement. And there's also an angle. When there's uncertainty, the sector that will struggle the most from sentiment, the share price will go down. It tends to be banking. Like in the year 2016, when there was interest rate cap, the share price is actually fell by close to 50%. At the peak of COVID, the same, because that sector is very sensitive to the economic sentiment. So actually is an opportunity for you. It's like there's rain there and you have a bucket. It's up to you now to go and collect the water.
Thank you. Okay, I can see a lot of questions that can be batched together. So Esther, you can take that question around ZD. Maybe somebody who missed the beginning of this webinar, what is ZD about in brief and how they can take advantage of ZD. I can see also Jackie Roche is saying, can I get dividend with ZD? So just unpack ZD for our listeners.
Okay, great. So ZD is our wealth management platform on Empessa. And at the moment, we've got 2 wealth management tools. The 2 tools are as follows. The very first one is the money market fund, which is akin to a savings account where money is put in high-yielding investments. And that's the one we started it. We launched ZD Money Market Fund last year in February, so that, you know, any amounts that are sitting in your wallet, you're able to invest them, you know, over a period of time. The process is very simple. You simply, you know, it's a 3-step journey. You click on invest, put in the amount of money you want from your wallet, and then you're able to invest and earn money earn interest on a daily basis, but based on an annualized rate. So it's predominantly a wealth platform, but a savings platform. And when you want to withdrawal is instant. At any particular time, when you need your money, you will get your principal and the interest that has been accrued in whichever denominations you're looking for. So that's the money market fund. So ZD has a money market fund, which is a savings tool. ZD Trade, on the other hand, is an investment tool. And the difference between savings and investments is that you're then putting your money in a piece of a company on the securities exchange. And a piece of a company on the securities exchange is when you're able to buy 1 share of Safaricom, 1 share of KCB, and that becomes your portfolio. And then to tie to the question around, will you get dividends for these shares that you hold? Will you get the bonus or rights issues that go with this? Absolutely, yes. You are a shareholder. So what we have done is your KYC or your identity is linked to your identity when you enrolled as a Safaricom customer, as an Empessa customer. And likewise, when you're investing, you're using the same details, which is your registered ID, to determine who you are. And when you purchase the shares, again, those shares are linked to your identity that you're provided with us. And so, yes, you'll be entitled to get the dividends of the shares that you have purchased. You'll be entitled to any other, to any rights issues that are related to you as the owner of that share. So the baseline, the entry point, and to the question around whether your shares are secure without a CDSC account, there is an underlying CDSC account, but that CDSC account is linked to your individual identity. So there's no chance of losing your shares or not participating in the corporate actions, which include dividends, rights issues, etc., that's linked to the shares that you own. There's a very robust process in the back, and we've integrated directly with the Securities Exchange. We've also worked with a stockbroker, and we're working with multiple stockbrokers to ensure that the linkage is clear, your ownership is clear, because that is how you build long-term wealth. So that is the difference between the money market fund. Because a money market fund, it's basically you're investing, similar to a savings account. On the trader solution, you're buying an asset, which is a long-term asset that you buy and you sell, and you also participate in the upside when the shares go up. You participate in the downside when the shares go down, but also receive dividends as part of that process. So, Claire, I believe that answers all the questions around ZD.
Yes. Thank you. Thank you so much for that. And our time is far well spent. I can see a lot of the questions someone answered during the webinar, and I've seen some questions about whether the recording will be available. Yes, it will be available. The Abojani WhatsApp channel is there, so the link will be shared, and it will also be shared on the Telegram channel. So in case you missed any part of the conversation, you can re-listen and get the answers there. And remember that FAQ that Esther talked about. Some of these questions are answered therein, so please visit the Safaricom website and you can find out more about some of these questions that you have. And then there's some questions that are very personalized, so you can also join the Abojani Masterclass and become part of the community and get some of those personalized questions answered for you. The next masterclass will be happening from the 6th of April, so participate there and you can get all the information you need. But as we wrap up, I'd like to give our panelists a chance to talk to our listeners one last time. And I will start with you, David. People have been listening to this conversation throughout, and if they are still on the periphery about how or whether they should participate in the stock market, what is that one piece of information that you would like to leave with them to convince them to get part of the action?
Let me repeat what I said when we started this conversation. That currently, if you look at the measure of the market, we are trading from an index perspective at around 3,500 points. This measure is being guided by the 20 companies that were there those 15, 20 years ago when the index point was at 6,100. You will find that if you look at the performance of those companies, it has more than doubled. The index has halved. So the people who might still be on the fence, I would like to play that very factual data point information and guide them that given that the performance has gone up, the index point is significantly slashed by half. It means probably there is an opportunity in there. So depending on the side that you want to be in, whether it's on the sell side or on the buy side, then strictly speaking, no one should be at the fence. The opportunity is as white as it can be. So I want to encourage them that probably the time to be in the market is now. For them to be able to take advantage of these opportunities, and given the very, very interesting and very cheap way to come to the market through one share. And the tools are there again, so no one should be left out, and the time to come to NSE as a destination of investment is now, in my view. Thank you.
Thank you. Thank you for that. The time is now. Don't sit on the fence. Mama Empessa, Esther, give us your last word. Talk to the people about being part of the action and investing.
So mine is an encouragement. We are here to serve. We're here to make sure that you can prosper. So my call to action here is we've given you the tools. We're partnered with the right people to give you the right insights, the Securities Exchange, Abojani. And so my encouragement today is start. Start small. Be consistent. Deliver on your long-term aspirations. So mine is really an encouragement to say, start small, keep growing, be consistent, and you will deliver a long-term wealth proposition. Simplicity is the key. Don't complicate it. Embed it in everything that you do, and you will win. Use ZD Trader, which is found on the Empessa app, and integrate all your financial well-being on one tool where you can get the right insights to help guide you with the decisions that you're going to be making. Thank you.
Thank you so much for that. Indeed, simplicity is the ultimate sophistication. So don't overthink it, just get in there. And last but not least, Robert, what will you tell all our listeners here about being part of the action in investing?
Yeah, so first of all, I want to thank Safaricom, Esther, NSC, David, and the people behind the scenes who made this a success. So the whole idea of Abojani is to ensure that financial conversations are expert driven. So that guided kind of conversation. So that's something that we are really grateful about, and we'll continue to have such sessions. So from my end, I would say that this is the best time globally to be level-headed. Like if you can just say that you are going to do something and you do it, something that helps you, you'll be among the 1%, because there's information overload and everyone is trying to do something that fit into other people's agenda. So just take your goal, what you want to do, and I can encourage you, just do it even like a robot. Like every month, buy shares worth 5 Kenya shillings. By month 4, you want to be the same person. If you are Esther, you'll be Esther 2.0. The way you hear, now you have Empessa 2.0. When Empessa started, it was just person to person. Now it is Lipa na Empessa, ZD and the rest. So for you, you cannot upgrade yourself with vibes. You only upgrade yourself by doing. Yeah. So do, and you'll become like you see a caterpillar and a butterfly, such kind of transformation, or water comes and ice. So a transformation means that you'll be materially different in a positive way 12 months from now. So I'll encourage you to be disciplined, get a position in a company of your choice. Like David has shared, the prices are attractive. Look at the valuation. And I can give a practical example. In 2014, our Kenyan analyst, they used to value banks based on price to earning ratios, and the benchmark was 10. Now the companies are trading at price to earning ratios or 4 or 5. No one is talking about price to earning ratios. We have other funny ways of valuing. So it just shows you that the opportunity is right here with us. Capture it, be consistent, and keep going. And I wish you all the best. Happy investing.
Thank you. Thank you so much for that. As we said, the recording will be available on the Abojani WhatsApp channel, the Telegram channel. I saw someone asking about it. Go to the X page at the Abojani and you'll find out what the channels are and you'll get the recording. Abor, that omnibus question was answered by Esther. Please listen to the recording again in the interest of time. And thank you all for listening in. Thank you so much to our panelists, Esther and David, for the insightful session. And we will continue to bring these more and more of these sessions that you can be enlightened. So as I said, the next masterclass for Abojani is on 6th of April. So go to the X page for more details and be part of that. So until next time, I'd like to wish you all a good evening and happy investing in the stock market.